All right, today we're doing a deep dive into a really fascinating company from an investor's point of view, American Waterworks. This is the biggest publicly traded water utility in the US, and we're going to break down exactly how it works and why it's considered such a foundational blue chip stock for so many people. So let's jump right in. So think about this for a second. As an investor, what's the dream? You want a business that sells something everyone needs all the time, no matter what, right? Well, it's tough to find something more essential than water. And that really simple, powerful idea, that's the core of everything we're going to talk about today. Okay, first up, the ultimate essential business, and why water is just different. So let's zoom out a bit. What makes a water company so unique compared to, just about any other business out there? It really comes down to how the industry is built and the fact that its product is completely non-negotiable. Check out this number, $625 billion. And get this, that's not some Wall Street analyst's guess. That's from the EPA. It's their estimate of what it's going to take over the next 20 years to fix and upgrade America's old, creaky drinking water systems. Now, for most, that sounds like a massive problem. But for a company like American Water, that's not a problem at all. It's a massive, multi-decade runway for growth, basically signed off on by the government. Now, this term, natural monopoly, is absolutely key to understanding this business. I mean, just think about it. Imagine trying to start a competing water company in your town. You'd have to dig up every single street to lay a whole second set of pipes. The cost would be insane. It's just not going to happen. And because of that, you get this natural monopoly, where one company is the only game in town. It creates this massive, almost impenetrable wall against any potential competition. Okay, so you might be thinking, wait, if it's a monopoly, what's to stop them from jacking up prices to whatever they want? Great question. And that's where this thing called the regulatory compact comes into play. You can think of it like a deal, a handshake between the company and the government. The deal is this. The utility gets to be the only provider, which is huge. But in return, they have to provide safe, reliable service, and state regulators get to decide what a fair profit is for them. This agreement, it's the absolute foundation of the whole business. And this right here, this is what makes it such a defensive business. You see these fancy words, inelastic and non-discretionary? It's just a finance speak way of saying something we all know intuitively. People use water whether the economy is great or terrible. I mean, you're not going to cancel your water service to save a few bucks during a recession, right? And for an investor, that is just golden. It means their revenues are incredibly stable and predictable, year in and year out. All right, next section, the utility growth machine, or how investment turns into profit. So we've got it. The business is super stable, but stable doesn't always mean growth. So how does a company that sells the exact same thing every single day actually grow its profits? Let's pop the hood and look at the engine. This concept is everything. It's called the rate base flywheel, and it's the absolute heart of the growth story. Here's how it works. Think of the rate base as a giant, government-approved investment account. Every time American Water spends $1 on a new pipe, a new pump, whatever, that dollar goes into this rate base account. Then the regulators let them earn a set profit on the total size of that account. So the more they spend on improvements, the bigger the account gets. And the bigger the account gets, the more profit they earn. It just feeds on itself, a constantly spinning flywheel of growth. And that flywheel is powered by two main engines. First, you've got all the spending on their own systems. That's that $625 billion opportunity we mentioned earlier, just constantly upgrading and modernizing what they already have. But the second engine is really interesting. They go out and acquire smaller systems. See, there are tens of thousands of little water systems run by small towns that are just struggling to keep up. They can't afford the upgrades. So American Water comes in, buys them up, and then what do? They invest a ton of money to fix them up, and all that new investment gets added to their rate base. It's a brilliant two-pronged growth strategy. Okay, but if you're an investor and you pull up their financial statements, you're going to see something that might make you panic. Negative cash flow, like a big negative number. We're talking a deficit of more than $800 million in 2024. For almost any other company on the planet, that would be a massive red flag. Sirens going off everywhere. So, what in the world is going on? And here's the crazy part, the paradox of utility. That negative number, it's not a sign of a problem, it's actually a sign of growth. All that cash going out the door is the money they're investing, building that rate base flywheel bigger and bigger. Every dollar spent is another dollar that's going to earn them a profit down the road. It's totally counterintuitive, but for a company like this, that big negative cash flow number is actually proof that the earnings growth engine is running at full tilt. Okay, on to our next section, the dividend cornerstone, which is really the investor payoff. We've talked about the business model, we've talked about the growth engine, but what does that actually mean for your wallet as a shareholder? Well, it all comes down to one word: dividends. And man, did they have a track record. We're talking 16 years in a row of raising their dividend. 16. This isn't some company that pays a dividend when they feel like it. This is a company that has proven consistently year after year that it's going to return more and more cash to its owners. It's about as reliable as it gets. And here's why that's so reliable. It's all about alignment. The company's dividend doesn't just grow randomly. Management has a very clear target. They want the dividend to grow right alongside the company's earnings, in that 7 to 9% range. It's a simple promise. As our business grows and makes more money, you, the shareholder, will get a bigger check. It's a direct link. So, is this sustainable? Absolutely. They're not stretching to make these payments. They have a really smart policy. See, they only pay out about 55 to 60% of their profits as dividends. What happens to the other 40 to 45%? It goes right back into the business to fuel that rate-based flywheel we talked about, which in turn grows future earnings, which then grows future dividends. It's a beautiful, virtuous cycle. So let's move on to the big question: risks versus the quality premium. In other words, is it worth the price? Because up to now, this sounds almost perfect, right? It's predictable, it's essential, it grows. But of course, no investment is without risk, and quality doesn't come cheap. So let's get real about the potential downsides and that high price tag. Yeah, there are definitely things you need to watch. First, everything depends on keeping those state regulators happy. If those relationships sour, it's a big problem. Second, environmental regulations. New rules about chemicals like PFAS could mean big, unexpected costs. And finally, interest rates. Because this company borrows a lot of money to build things, higher interest rates can really squeeze their profits. These are not trivial risks. You have to keep an eye on them. And that brings us to the price tag. Take a look at this. The market makes you pay up for quality. American Water trades at a price-to-earnings ratio of around 25.5. Its competitors, they're closer to 20, so it's clearly more expensive. And the big question for any investor is, why? Why are people willing to pay that extra premium? Well, the answer is what investors call a quality premium, and it really boils down to two things. First, diversification. American Water operates in 14 different states. That means they're not beholden to a single set of politicians or regulators. If they get a bad ruling in one state, it hurts, but it doesn't sink the whole company. Compare that to a utility that's only in one state, that's much riskier. Second is just pure scale. Being the biggest means they're more efficient, they have more experience, and they just tend to execute better and more consistently than the smaller guys. This quote really just nails it. For long-term equity investors prioritizing capital preservation, predictable growth, and a reliable, growing dividend stream, American Water represents a cornerstone blue-chip asset. I mean, that says it all. This is not a get-rich-quick stock. It's not for day traders. It's built for people who want to sleep well at night, knowing their investment is stable, growing steadily, and paying them a dividend that goes up year after year. It's the definition of a blue-chip stock. And that really leaves us with one final question to think about. In a market that feels more volatile and uncertain than ever, what is the real value of predictability? When you have a business built on something people can't live without, locked in by government agreements, and with a clear growth path for decades to come, that offers a kind of certainty that is incredibly rare. So the question you have to ask yourself as an investor is, what's that kind of predictability worth to you?